Right now, in an office tower in Tokyo, a man you'll never meet is quietly deciding what your next mortgage will cost. He's never seen your house. He's never heard your name. And he may have more influence over your borrowing costs than Jerome Powell. Because the biggest risk facing the American economy right now isn't AI. It isn't China. It's something so boring that financial media literally cannot make a thumbnail out of it. Mortgage rates that won't fall. Markets that lurch without warning. The answer isn't in Washington. It lives in Tokyo, inside the single most boring asset on Earth, a Japanese government bond. For 30 years, that bond was the duct tape holding the global financial system together. In 2026, it's peeling. To understand why, we go back to 1992. Japan had the hottest economy on Earth. Then its bubble burst. Real estate collapsed. The stock market collapsed. 3 decades of no growth, no inflation, no rising wages. Somebody hit pause on an entire country and lost the remote for 30 years. So the Bank of Japan cut rates to 0. When 0 didn't work, it went negative. Then it introduced yield curve control, capping long-term interest rates no matter what the market wanted. Japan didn't just lower interest rates. It put them in a medically induced coma and stood guard over the bed. The most important word in this entire video, repatriation. After 30 years of flooding out of Japan chasing yield, that capital is finally turning around and walking home. John's own bonds now pay a real return. No currency risk, no borrowing costs, none of the gymnastics. Why keep money parked in America? Here's why that matters to you personally. Japan is the single largest foreign holder of American government debt on Earth. Not China, Japan. And that reliable buyer is starting to skip meals. When demand for U.S. treasuries falls and supply keeps rising, the U.S. runs nearly $2 trillion deficits annually. National debt passed $37 trillion. Moody's downgrade in 2025. There's only one way to attract new buyers. You pay them more. Long-term yields rise and stay high. That means your mortgage rate won't fall the way you're hoping. Stocks get repriced lower as discount rates rise. Corporate debt refinances at painful rates. Companies hire less, build less, take fewer risks. The most likely version of this story is a slow leak, not a sudden crash. But the direction matters, not the speed. The buyer who showed up reliably for 30 years is becoming an occasional visitor. And who pays the price? Never the people who caused it. It's the couple who finally saved a down payment. The small business owner whose credit line quietly got more expensive. The guy 3 years from retirement watching his account shake for reasons no headline will explain. The bond market never raises its voice. It just changes the price of money underneath everyone and walks away whistling. The loud risks are already priced in. The one that takes you out is always the quiet one. The boring one. The one nobody's watching. It always has been.